Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. Investing in private markets has become very popular for retail investors as the benefits they bring to investment portfolios are more widely known and the accessibility to private markets has increased. But the world of private markets is vast and complex, which brings its own challenges. Well, I have on an industry expert to help us gain a better understanding of investing in private markets. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and bring on the star of the show. I'd like to give a very warm welcome to Matt Malone. Matt is the head of investment management at Opto Investments. Matt, thank you so much for coming on the show. It's an honor to have you. I'm really excited about this conversation. So, can you please tell us a little bit more about yourself in Opto Investments?
Sure. Thanks for having me on, Ryan. Excited to be here too. Appreciate you reaching out and taking the time. And love that you're coming in from Lake Tahoe. Have some good memories of spending time there. Yeah. So my background is I've been in the intersection of private wealth and private markets for about 20 years now. So I've been in this space since before it was the hot thing to do, before it was cool, and all the big asset managers wanted to get into it. It was a much smaller industry back then. And a lot has changed over that period. But at the same time, a lot has stayed the same. Investors are looking for diversification, non-correlation, other sources of income. So the role of alts in portfolios has not changed. It's just that the amount of options and the amount of strategies has grown quite a bit. So I'm sure we'll jump into that later. I've worked in the industry in a number of different roles. I worked in a research and diligence role. I worked at an asset manager doing product development, launching products, helping to run investment strategies. And then I came over to Opto a few years ago to start this business and to build this business. And really, the core thesis of Opto was looking at a number of market trends and seeing where the industry was going and what we thought advisors would need in the future, right? Because a lot has changed. And those big trends that we were seeing, I'll name you a few and then give you a sense of what we do at Opto. But the trends we were seeing was one, a lot more advisors moving into fee-based structures rather than brokerage-based structures, moving to the RIA format and needing to hold alts in fee-based accounts. So that created some additional complexity and changes from historically primarily brokerage-based transactions in alts. With that came along a couple other things, which is advisors looking to put alts more in a portfolio level. How do I integrate alts on a portfolio basis rather than just a trade? I need help understanding how to build an alts portfolio rather than just do a few trades here and there. So portfolio construction, and how do I build a thoughtful long-term allocation to all alts? And then needing more support and more solutions that are aligned and thinking more about conflicts. The way the industry has evolved and with the focus on fiduciaries and providing fiduciary advice, needing a resource that was aligned with between the advisor and the provider. And then, of course, wrapping all that in a technology solution, because as we all know, very difficult to scale an alts portfolio for a financial advisor. There's a lot of operational complexity. There's reporting complexity. You need to speak to a lot of clients versus an institution implementing an alts portfolio. You basically have one client. So the complexity of getting all the information you need in the same place, subscribing, reporting data, technology solution can really optimize that. So really what that brought us to was the core of Opto is let's build a private markets platform where advisors can build customized private markets portfolios and get research and advice that's aligned with their outcomes that they're looking to get from their alts portfolio.
Matt, that's fantastic. And I want to go back to your time real quickly in Lake Tahoe. I love stories, but sometimes stories in Lake Tahoe are better off not staying on a family friendly show based on what. But where did you ski when you were in Tahoe?
So I lived in North Lake for a little while. I worked at North Star, and I was living with a bunch of friends from undergrad. And so we had the whole North Lake covered. We had Alpine, and it used to be called Squaw Valley and Homewood. We had a great winter, tons of snow, super fun time for me many years ago. I have very fond memories. One one story I always remember about Tahoe is people were very friendly there. There were a number of us working at mountains. We had limited cars and limited transportation. So a lot of times I would end up starting to walk to North Star, which is not that close to where I was living. If you know where Carnelia Bay is versus North Star, there was a bus. Sometimes somebody would pick you up if you had a North Star jacket on and just drive you to the mountain. I remember one day somebody pulled over and I hopped in the car and the gentleman was talking on their phone, looked at me, kept talking, finished their conversation, and then looked at me and said, I was just pulling over to take a call, but it looks like you're going to North Star. So might as well stay here. Might as well stay in here and I'll drop you off. But that was the type of people you had there, unhurried, slower pace of life, and just friendly folks. So fond memories of Tahoe.
I love it. The vibe has changed a little bit because it's really crowded now, but
Too
I
bad.
still love it. I love that story, Matt. That's fantastic and great. Kind of, yeah, it details the vibe of Tahoe
Mhm.
from a few years ago. I love it. Back to Opto and
Yes.
alternative investments. I love that. You're exactly right. The foundation of alternatives or private markets is increased diversification, try and move that efficient frontier to the northwest corner, increase
Mhm.
returns, reduce risk. You know, but there's other, it's evolved a lot from, like you said, when you were probably in the industry working at asset managers. Where do you think the greatest evolution has happened? Is it technology like Opto, which is helping, democratize or bring private investments to the masses? Or what else in terms of the evolution has been the greatest piece there?
Well, I think there's a few pieces. I think initially there was just the amount of strategies that were coming to the wealth space. In the old days, there were just a few It was primarily real estate focused investments. You had the early non-traded REITs, 1031 deals, things like that, maybe some hedge funds. And then you had private credit as one of the sort of newer asset classes that came in the early 2010s, let's call it, maybe a little earlier. And now we're seeing private equity and venture and the other major food groups within private markets, infrastructure, all. So that was the first piece. And then I think we've seen a lot of structural innovation alongside that. And I think that's actually really taken off in the last few years. I think there was some aversion to having too many different structures. I think for a period of time, it was too confusing trying to educate the market on both what is private credit, what is private equity, and by the way, there's also these all these different structures that you have to figure out. And so I think while there's still work to do, I think there's broader understanding of a lot of the different strategies and the role they play. And so now there's some more structural innovation on how do we manage liquidity, how do we manage risk, how do we use leverage appropriately. So there's this whole set of structural innovation, and the tech is coming along, but frankly, there's still a lot more to do. I think a lot of the technology has been focused on making subscriptions easier, doing basic reporting. But I think there's a lot more to do in the stuff we're working on here in terms of deeper analysis, planning, portfolio construction. There aren't as many solutions there that you would see in the public market side for an advisor. And so that's where I think we're going to continue to see innovation is how to use technology to help model out portfolios and do forward-looking portfolio construction for folks.
Yeah, Matt, that's a great point. And you mentioned education too, as this space has grown. I'm at fault here about, just saying alternatives and just throwing it in one bucket, but it is so vast. Like
Mhm.
you mentioned private equity.
Mhm.
It's just private equity. Within private equity, that umbrella, there's secondaries, venture capital, you name it,
Yeah,
just all in the education and it's not just a basic public stock, public equity. And like you said, there's challenges there. Yeah.
absolutely. We could go so many directions with that setup. First, look, we all have to be careful with the education we consume and going back to alignment and conflicts. There are a lot of asset managers and other folks putting out great educational pieces, but there's also a lot people, of course, that's always, there's the idea of getting a sale at the end of that education. And so taking
Yes.
all that with a grain of salt, understanding the source of information. And there's nothing wrong with that. I think people just have to understand where they're consuming and what that means in terms of the angle they'll be getting on the market. So I think that's education. The industry's done a great job focusing on education. I think you always have to be careful with where you're sourcing that education, understanding the point of view, just like you would with any other piece of news or information you get. You have to understand where it's coming from. So I think that's important. And when you talk about private equity or any of these other things, another thing that's challenging to somebody that's newer to the space is there's not even consistent usage of some of these terms within the industry. Like, one of the things that confused me for a long time earlier in the industry is people would say, I'm private equity real estate. And I was like, what does that really mean? And or I'm private equity this. And so sometimes you hear people using private equity and they mean private equity structure. They mean an institutional private equity structure, like a drawdown vehicle. They don't necessarily mean the private equity investment strategy, investing in private companies to grow cash flows and hopefully exit at a higher price. So there's not even an agreed upon vocabulary and nomenclature that is used in the industry. And so you have to be really smart and have not necessarily smart, but just have the experience and know the contextual clues for when someone's saying private equity. Do they mean in this context a private equity investment strategy? Or they mean is a drawdown vehicle? Or maybe it means something else. Maybe they don't know what private equity means. So it continues to be difficult to navigate because of that.
Matt, that is spot on. I've been attending a few super return conferences, which are focused on private markets, and I've helped moderate some. And as I'm moderating, sometimes I'm almost to the point Googling some of these terms that people is like, what in the world does that mean? I've never heard that. And like I said, it describes kind of the same thing as somebody else using a different term, but it is very complex. And I'm glad you brought that up because that is, I wouldn't say an issue, just but it just makes it a little bit more difficult to understanding all the terms and complexities and then the inner workings of private markets. What you talked about, Opto's helping, and then the number of products out there, and is helping making private investments more accessible to the retail side, and a lot of things going on there. What are some of the benefits of that increased accessibility to the private markets?
Look, I think the benefits are having more options. I think a private markets investment or an alt investment is just like any other investment in that the buyer or the user of that investment should think about what kind of outcome they're looking for and also what amount of risk they're willing to take. Risk, of course, is a little bit more difficult to gauge in private markets because in public markets, we gauge risk with volatility. In private markets, we don't really have a volatility measure. So gauging risk is more complex in private markets. But going back to your question about choice, I think that it's a double-edged sword because, you know, again, 10, 15 years ago, if you wanted private credit in a private wealth portfolio, you had one, two, maybe three options. It was a binary choice. Am I going to put private credit in or am I going to not put private credit in? If I'm going to put it in, there's only a few places I can put it. Now there's just so much choice. You have sort of the large evergreen vehicles for private credit. You have more of the drawdown style institutional funds that now retail investors, QPs are investing in. You have in between options where you have a private vehicle that's staying private for a while and maybe listing in the future. And all these things have different risk return profiles, a different experience over time. And so it's not even just saying I want to be involved in this asset class. It's also which way am I comfortable getting exposed to this asset class? And what trade-offs am I willing to make? That's usually that's a lot of the conversation we have with clients is what trade-offs are you willing to make? Because you may think, look, you may think a drawdown structure generates higher returns, but are you willing to deal with managing capital calls and getting a K1 and all of those things? You may say, look, yeah, maybe I could get a little more return out of this, but I want the ease of use of the sort of evergreen structure, or maybe I want something in between. And there's constantly, go back to your earlier comments, there's constantly innovation going on where people are trying to optimize structure and meet different demands and present a different set of trade-offs to investors.
I'm a firm believer that, options are good. Help the retail investor or the financial advisor really provide a customized, tailored portfolio for their
Mhm.
client. So options help that. But like you said, there's a lot of it brings on a whole new, you know, can of worms there too, in terms of just
Mhm.
like you said, the different type of products and all, like we talked about earlier, private equity is just not private equity. Lots of other things in private equity, even real estate too. A lot of different things within real estate. It's
Absolutely.
not, like you said, black and white. There's a lot of other things at play. And I'm assuming there's other issues that this, increased accessibility has caused. Anything else that maybe we don't really think about?
Oh my gosh, I don't know what's going on with what everybody's thinking about out there. Some of the things I think about are just supply demand of capital, because of proliferation of products in certain asset classes. There's just more and more capital supply, and thinking about whether that supply and demand is in balance for the market opportunity, and also what other players are active. To pick on private credit a little bit, that has been heavy capital raiser. We've seen At the same time, we've seen private equity grow, which is the primary user of private credit. So we've seen more demand, we've seen more supply, but then we've also seen the banks, which sort of pulled back for a while. Now we see at the upper end of the private credit market that the broadly syndicated loan bank market is starting to compete with the private credit market. The banks are also financing the private credit vehicles as well. I think that's what we think about a lot with different strategies is oftentimes what happens in private markets is if you can find an area where there's less supply of capital and a need for capital and somebody that is clever about providing that capital and knows how to manage the risk, I think that's where you get outside returns. And then look, the market is efficient. When people see that outside return, more money flows to that sort of alpha generation can get squeezed. And then as that market evolves, fees come down, expenses come down to try to continue to generate that same level of return. And so I think that's what we're seeing happen in certain parts of the market, more mature parts of the market. But there are other parts of the market where there's a lot of strategy innovation going on and there isn't a lot of capital. And so the risk return is skewed in the other direction.
Just I love that, and it just goes on finding alpha. And like you said, when other people realize there's an opportunity to find increased alpha, and the herd's gonna follow, right? So very good point. Let's talk about the different vehicles too.
Sure.
Again, it can be a little complex, but one of those just start maybe higher level. There's that direct investing or co-investing in private markets. Can you just give
Yeah.
us a real quick understanding of really what's the difference? And maybe a retail investor, is there one that maybe they should migrate more towards, like direct investing or co-investing?
Yeah, and this is another place where, having the shared vocabulary helps. I'd say the way we use those terms here at Opto, the way we think about that is co-investing generally means you are investing rather than investing in a fund, you're investing in an individual investment, but alongside a sophisticated investor or a fund sponsor. Historically, it's been more in private equity. We're seeing it in venture. We're seeing it to a certain extent in private credit. But anywhere where a sponsor has a deal where, for whatever reason, they can't fund that deal with their fund, maybe they're trying to limit concentration, or maybe it's just too big for their fund, they may go back to their investor base and say, "Hey, we have this deal. We really like it. We only have we can only fund 50% of it with our dollars from our fund. We'd like to fund the other 50%, and we'll offer that out to our investor base at a reduced fee." That's typically how a co-investment works. And so the trade-off that is basically being offered to investors is, hey, you maybe invested in a fund, you're getting a diversified portfolio, you're paying a little more, but here you're taking some concentration risk because you're making a bet on an individual company or an individual transaction. And so we're going to offer that to you at a low or no fee point, but you're still investing alongside that sponsor that you've already underwritten and gotten comfortable with. So, to a certain extent, maybe you feel like you're comfortable with that investment because you're getting more exposure and you can average. So, you can do that as an investor On a one-off basis, I think the way we think about it, the better way to do it is do it on a programmatic basis so that you can get the similar exposure that you were looking for on the front end, but you sort of dollar cost average your fees down. So it takes a little bit more work. You got to be able to move quickly. You got to have some capital available. And that's a co-invest piece. When we say direct investment over here, now you're removing that other sophisticated party. So you're removing the private equity sponsor or the VC sponsor that's coming alongside and bringing you that deal. And you are just, a company is coming to you, whether it's from your network or from somewhere else that is raising capital. And so there may not be another trusted party alongside of you going into that transaction. And so in that case, you're now taking on a lot more work, or you should be if you're a conservative investor, to actually really underwrite the company yourself and make sure you understand the risk. And so in that case, you're going directly with the company, you're going alongside with that company. You may not be paying any fees, but you may be taking on more risk because you don't have a professional investor alongside of you. So, that is another area where we do spend some time. I'd say that the way we approach both of those things, the co-invest can be a little more programmatic and having that capital and sort of dollar cost averaging, building a portfolio of that. The direct investment, look, as we all know, a lot of people like to invest in part of investing in private markets is the story, right? People like to be able to tell an interesting, exciting story. I invested in this company. Here's what it's doing. Maybe it's aligned with my values. Maybe it's aligned with my profession, something I believe in. And there's nothing wrong with that. And that's part of investing, is putting money into things that you care about. But I think, again, you got to go back to managing risk and saying, okay, this is a direct investment. I did as much work as I could. Maybe I'm super comfortable with this company. Maybe I'm medium comfortable. I'm going to size this investment appropriately. Maybe it's a tiny 1% out or smaller allocation of my portfolio, so that, yes, I can still participate and I still get to feel good about being part of this investment. But if something goes wrong, I don't go down with the ship. And if something goes right, it's still meaningful to me. If it's a 10x, it's still meaningful to me. But if it goes wrong, I got plenty of other options to put money to work, and I'm not going down with that company.
Great description of this too, Matt. Thank you. I'm assuming, just as you're explaining, that for large majority of financial advisors in the retail side, co-investment's probably the more popular one. I'm
Mhm.
assuming because you're going alongside a professional investor. You got that accredited investor, the sponsor that you're going alongside. Direct investing, it seems like it might be a little bit more work involved and more due diligence, which maybe we're not really set up to do compared to
Yeah.
co-investing. So just my observation there. So continuing along with the vehicles, two vehicles that I hear a lot about, and I've done some research on and
Mhm.
content on, is tender offer funds and interval funds. Interval funds, I hear a lot on the private credit side,
Yeah.
very popular there. Tender offer funds, what's the difference between the two of them? And between those two vehicles, is there one that's better suited for a specific type of investor?
Yeah. So they're both, let me go into a little bit to my lawyer background here, but right, they're both 40 Act funds. So they're both 40 Act registered type of funds, which means they're subject to 40 Act is the only body of security law that's really prescriptive about what you can do. Most of the other parts of securities law are just say, you got to disclose things. You got to tell people what you're doing. But as long as you tell people what you're doing, you can do what you want. There's like a freedom of contract idea in securities law. It's very disclosure based. But once you get into 40 Act land, then there's some rules and restrictions on what you can and can't do. There's leverage limitations. There's needing to have a independent board. There's all kinds of things that you're subject to once you enter to 40 Act world. So for a private wealth investor, there are some built-in protections to those structures that you might find very valuable, because it's meant to limit certain types of risk that a manager can take. So there's a lot of similarities between those two structures. The main difference between the interval fund and the tender offer fund is, in the interval fund, you are basically required to offer liquidity on a regular basis. There's some flexibility with how you offer it. There's certain percentages you can meet. There's certain timelines you have to meet. But the industry, I'd say, has coalesced around 5% a quarter. give or take. There's some variation in that, but the industry is coalesced around 5% a quarter. If you're an interval fund, you're offering 5% a quarter. The other interesting benefit, um, both to sponsors, to the consumer as well, if you're an interval fund, is a lot of the custodial platforms and trading platforms treat interval funds a lot like mutual funds for purposes of investing. So you can ticker trade, which makes it a lot easier to interact with, right? Because they offer this required liquidity, you have this sort of ticker trade, which you can't always do with every structure. When you go to the tender offer fund structure, which has seemed to fall out of favor, it seems like the interval fund structure seems to be winning between the two. The tender offer structure is very similar in that you're basically offering ongoing liquidity to investors, but you're not required to do it by the body of the law. You're basically contractually saying you're going to make, usually how it's structured is you're saying, I'm going to make my best efforts to offer 5% a quarter or 5% every 6 months or something else. So you're telling investors, I'm going to try my best to give you liquidity, but there's a chance I may not. And that is a little bit different experience for an investor. A lot of people love having the regular ongoing liquidity. The other side of that equation, if you're an asset manager, so sat on that side of the table, is managing that liquidity is a real challenge. Because if you think about where you're sitting in the asset manager side, you have an existing portfolio, which has its own dynamics of where cash is going. A lot of these vehicles are paying ongoing distribution or dividends. So you got to understand how you're going to fund that distribution or dividend, because investors want that to be very consistent and they generally want to be going up and not down. We just saw some distributions go down and a lot of redemptions come in a certain part of the market recently. But the other thing that's happening is you don't know how much money is coming in, right? So if you think about you're closing every day, every month, every quarter, you don't know how much money is going to come in. You don't know how much money is going to come out until the end of that period. And the expectation is you pretty much have to deploy that capital immediately. Because if you don't, you have cash drag in your portfolio, you're going to have trouble managing to your dividend. The more liquidity that the manager is offering, the less wiggle room, the less margin for error you have in terms of putting money to work and keeping it meeting that return hurdle so you can pay your dividend and be consistent. So it's a real challenge. There's lots of levers you can pull. You can use leverage facilities. There's usually people are reinvesting distributions. So some of that money is coming back. You don't have to actually pay it in cash. Sometimes you see people waiving fees or expenses, saying, if I can't meet my distribution requirement, I'll waive fees or expenses to make sure we hit it. But that's the challenge. And that's the challenge the market is putting on asset managers, is saying, we want liquidity, but we also want you fully invested at all times. Figure it out. And so you as an investor have to say, is this vehicle of a size where they can efficiently do this, right? They can efficiently put the money to work. The size of the vehicle versus the size of the market and the transaction volume every year. Does this make sense? Can this still work? And that's changing too. The size of the private credit market has grown exponentially since I started working this business. There's a lot of moving parts, but I think bottom line is that's the challenge: is investors want it all. They want liquidity and to be fully invested and high returns and nothing ever go wrong and everything to go up and to the right. And look, asset managers want to give it to them because they want to raise more capital, but it does present a lot of challenges. And so that's you really have to think about, is this structure aligned with what I'm trying to accomplish?
Matt, that's awesome. I never really think of on the interval fund side. It is very a lot of dynamics. Or usually we think of on the on the investor side. Yes, interval funds great. You get that 5% or whatever it is, monthly or quarterly, whatever the interval is, and they love that, right? They love that that check they're gonna get in the mail. I don't know if they have checks anymore. It's probably something else. But a lot of people don't really talk about on the asset manager side and the issues that it causes, right? But trying to bring those two together so the asset managers meet the needs of the retail investor and vice versa, I'm sure it probably does provide some difficulties for the asset manager. So
Yeah, look, the other piece, just to put a bow on that, like the different strategies have different solutions for that. So if you think about the private credit market, or think about any private asset, there's not just a list of private deals that are sitting around waiting for you to give money to for the most part. The reason why these are tend to be more expensive, higher fee is because it takes work. It takes work to source those deals. They close episodically. They're not closing all the time. They might not close at the same time your money comes in. They might close before your money comes in. So, you have to find something to do with that capital while you're waiting for some of these deals. Or you can some sponsors may warehouse them and put them in, but then you have to think about transaction price. So there are some markets that lend themselves more to that cash management solution. Historically, in private credit, the high yield market and the broadly syndicated loan market, which are quasi liquid markets, have funded that liquidity bucket while you're waiting for the private credit transactions to close. There aren't If you think about private equity, there's not like the corollary there would just be like putting your money into public stocks, which is going to cause a very different experience for an investor. If you have a liquidity bucket that consists of the Nasdaq or the S&P, it's gonna introduce a lot of more volatility than people are used to. And so the different asset classes have different ways to solve for that, and some are better than others.
Fantastic. Let's just shift here real quickly at the last topic here, and it's about financial advisor. What are some of the questions? They're doing a due diligence maybe on a private
Mhm.
manager search. Like you said, when you're looking at a private or a public equity, you're looking at volatility, however you measure volatility. Here, the risk is a little bit different. What are some of the things a financial advisor should consider or ask when conducting that due diligence on a private manager?
So I think I like to think in threes because it's easy to remember. And I like alliterative things too because it makes it even easier to remember.
Yeah.
So my little like rubric for diligence in private markets is sponsor, strategy, structure. Those are the three buckets of things you have to think about and get comfortable with. And there's a few sets of questions within each one of those, right? So the sponsor, meaning the company that is putting the investment together, do they have the right people in place? Have they been doing this a long time? Do they have the right infrastructure? Can they execute on it? Do they have any legal and regulatory stuff in the background? Those are the types of things. Can they support the growth that they're looking to? So, is the organization behind the strategy set up to make the strategy successful? And then, what is the strategy? Is it a sort of tried and true, something they've done a long time? Is it something new? What is the risk? Are they using leverage? Are they not using leverage? Those types of things, understanding the strategy. Because a lot of times, it's very easy to get a pitch deck, and the pitch deck is going to be the the highlight reel, right? They're going to tell you all the best things about what they're doing, and they're probably not going to tell you about the things that are riskier or that they might not have as buttoned up. And everybody has good and bad. It's not meant to be, no, it's not meant to be a hide the ball. It's just that's what you do when you're first introducing yourself to somebody is you tell them all the good things. And so it's very easy to get carried away with that initial deck and say, wow, this sounds really good. And so I always go back to let's think about those things: sponsor, strategy, and then the structure, which you've already talked about: interval funds, tender offer funds, drawdown vehicles, something else, private to public, all kinds of things, right? But is the structure aligned with the strategy? So is the liquidity in the structure aligned with the underlying strategy? Are the fees and expenses in line with the market? Is the whole structure set up for the success of the investor or more for the success of the manager? Is the manager going to be more profitable when the underlying investor is successful, or are they just going to make a lot of money just by raising assets? So those are the types of things. But I think always going to that back to those three categories, I think is a good way to ground the process, because a lot of times one of those three things will not be given to you right away. And so you have to make sure you feel comfortable with all three of those things, at least on a surface level, before then you do the next level of work.
Interesting, Matt. On the public side, we talk a lot on Zephyr about and do a lot of like education and research about focusing on the qualitative side versus the quantitative side. And whenever you're doing a manager due diligence, and that qualitative side is always more difficult. And what you just explained in those three buckets is really more on the qualitative side versus the quantitative versus looking at return and risk. It's like, who am I investing with?
Yeah.
What is a firm? And so it's very similar to the public side. You might just be asking different questions, within those three, whether it's private markets or public. But it's interesting. I feel like when I started in the industry 20 years ago, we focused so much on return, risk metrics. Now it seems like it's shifted, Matt, now to more on the qualitative side. Are they running this money out of a garage, or is it actually, a real
Yeah.
structure, like you said, and infrastructure set up?
Yeah, look, my underlying assumption is that's the first screen. And just to throw another sort of hot topic in here as we're, I think, coming to towards the end of our time, we've been using an AI-enabled solution to do that initial screen for us. So if you think about the way private markets work, our investment team is getting, pitch decks all the time from all types of, from VCs, from private equity sponsors, private credit sponsors, you name it, it's coming in. And the initial screen is, okay, does this even pass the smell test? Is there a track record there? Does it have all the right pieces of information we need? Is their performance top quartile or alpha generating for the place they're in? So we've implemented an AI tool, and this is something we think AI is really good for, because you're getting all this disparate information and you basically want to pull it out from each of these things and be able to compare it really easily. And so we're using that as our initial screen, is we can pull out the basic information, put it into a standardized format, make it easily comparable, and say, okay, we got this new deal. How does it look versus the 5 other deals that we like in this space? And so if it passes that kind of sniff test of, is the basic information there? If this is all true, do we like this? Then you go into those next stages, right? And so I think that's another, going back to, again, some stuff we talked about earlier, technology and implementing technology. I think there's a whole nother wave of technology coming that's going to help people sift through this private markets information, make sense of it faster, so we can spend more time on the qualitative stuff. We still go out and do on-site visits with managers before we invest. Like we go and meet with people and sit down to the office, because you get the vibes, you get the sense of, is this an organization that's aligned, where people like what they're doing, what's well resourced? And so I think there's still a lot to that I don't know that everyone is still doing in our technology age, as we do this over Zoom or whatever
Yeah.
platform.
Exactly, exactly. I don't those on-site meetings, it seems like they just don't happen as much as a Zoom, right? Let's just continue on. Last thing here about
Yeah.
the due diligence part. When you're just thinking about private investments or investing in private investments, whether it's private credit, equity, real estate, is there like a topic or maybe something that a financial advisor or any investor doesn't give enough consideration to when they're looking at a portfolio? Is there something that maybe we've talked a lot about just investing in it, the benefits, how, where? Is there something that maybe you think people should consider more?
Yeah, I think it goes back to risk again. I think it continues to be something that's very hard to measure in private markets. I think a lot of people just are saying, "Hey, this is private credit that generates 10%. This private credit generates 9%. Or this real estate that generates 12%. This real," and all of them have very little volatility. So I'm going to pick the highest number, because why not? I think, what you got to ask yourself is, what risk are we taking to get to that number? And is it aligned with the risk tolerance I have? The levers people pull are leverage. There's lots of leverage used. Not a bad thing, as long as it's used appropriately. There's a great story one of my old colleagues used to tell about leverage. And he said, leverage is like the fire under the barbecue. Okay, it's not a bad thing, it's a necessary thing. But if you don't have enough, the steak's not going to get cooked. And if you have too much, it's going to get burned. So you need to have just the right amount of leverage to cook the steak all the way through, not cook it too fast, not cook it too slow. And I think understanding that is important. I think there's all other types of risks that people are taking to get to their return. And that's what we do as investors, right? We take risk. Risk is not a bad thing. It's just understanding the risks that you're taking and what can go wrong. And I think there's not enough time. There's a lot of time spent on, what level of income can I generate? What correlation benefits can I get? There's not a lot of time spent on, what is the risk being taken to generate this return stream? And is it structured in a thoughtful way? Because it's hard. We just don't have consistent ways of measuring that across asset classes like we do in public markets. There's ways you can do that when you start to unpack these things. Even in a venture, like in venture, for example, most people are looking at TVPI and a drawdown fund. They're saying, oh, this is a 4X fund, this is a 5X fund. But how did they get there? Did they have one breakout deal? They did 100 deals, 99 of them were wrong. One deal was 1,000X and you got a 5X return. Or did they do 10 deals that all did between 3 and 7? Which manager would you rather? You get the same net return at the end, but what do you think is more repeatable? The 1 out of 100 or the pretty consistent 10? Where would you rather invest? And so you got to do that additional peeling of the onion to understand each asset class within private markets. It has a different framework for analyzing that. So I think that's really, and that's what these institutions have teams and teams of people doing that the private wealth space does not really have, is unpacking that stuff and trying to understand risk.
Matt, awesome, fantastic, and it just like it, basics of wealth management alignment, making sure that investment aligns with the client's risk tolerance, investment objectives. At the end of the day, that's kind of the foundation of that private wealth space, and being a fiduciary. Matt,
Absolutely.
great conversation. So much fun. I learned a ton. I know the audience will learn. I'd love to have you on again. Maybe do a Justice for Risk After Dark episode. Talk about Tahoe. Get a few other people. We can just talk
Do it in
Tahoe
Tahoe
for.
City. Yeah, we'll find a place in Tahoe City to do it.
There we go. Yes, we could do it on the chairlift. Do it on the
There you
chairlift
go.
as we're going up.
Mhm.
Awesome, Matt. Thank you so much for coming on the show and sharing such great insight. Honor and privilege. Where can our audience get more information about Opto Investments?
Sure. Look, we're optoinvest.com. We're easy to find. And yeah, check us out on LinkedIn. I'm on LinkedIn. I'm sure everybody else is on LinkedIn too. We definitely put out a lot of content, blog posts, educational content, you name it, it's out there. And look, yeah, if you're looking for help navigating private markets, we're here to help, and reach out with questions. We'd love to talk to financial advisors, RIAs that are trying to navigate this and figure out how to best implement their private market solutions.
Fantastic, Matt. Yes, it might be hard to believe to some, but I do a little bit of research before we go live in the website Opto. You guys do some great content there. A lot of good blogs, videos. Help a lot of people. Great resource there. Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Also, please be sure to like and subscribe those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.
Thanks, Ryan. Appreciate it.